Welcome back to Financial Therapy. It's not just about the money. I'm personal financial planner, columnist, and financial therapist Rick Kahler. Research tells us that 90% of all financial decisions are made emotionally, not logically. For nearly 4 decades, I've been helping people make better money decisions. So what makes my financial worldview different from most financial experts? I blend the nuts and bolts of financial advice with the emotions that drive making them. Good money decisions are not just about the money. So let's get started with today's episode. Welcome back to another episode. This is actually the second episode on this, but the first one, the mic was turned off. So it really upsets my very productive parts when I spend 25 minutes for naught. All right, that's probably information you didn't need to know, but there it is anyway. So what I wanted to talk about this time is emotions around investing. And I don't believe I've done any podcast on this because this is a financial therapy podcast, right? It's all about emotions and your money, right? Well, we know that when it comes to investing, that there's tremendous amount of emotion in investing. And we are about wanting to make really sound financial decisions. I mean, part of what financial therapy is all about is learning to make financial decisions that are in our best interest, that are actually helpful and not hurtful. And financial therapy is pretty unique in the fact that you can actually judge the progress when you're doing more traditional therapy. You can have a sense of the progress. I have a sense of the progress I've made in my many years of doing therapy, but it's usually not as tangible, as external as financial progress would be. So I would hope that one of the outcomes of doing financial therapy for all of us would be establishing a retirement reserve or money that's going to be there to support our quest for meaning after we stop earning any. So we kind of have, in a way, 2 pots of money that support our quest for meaning, our income today and supporting us in our quest today. And then when we don't have an income, we still need money to continue to help support that quest. And popular sources of financial income when we retire are Social Security and pensions. Social Security, all of us in the U.S. will get that. It's very minimal and barely, in most cases, I don't even think it takes a person above a poverty line. Pensions usually come if you had a career with some type of government. So for most Americans, it's Social Security and an income coming from the money that they've saved in retirement plans. So I think it's pretty important. Investing is important. My profession of financial planning has often overemphasized the investment part, but that's not to mean that it isn't important. So I want to talk about that today, and I especially want to talk about emotions because right now, emotions in investing, because right now we're hearing a lot about bear market. And our financial press has a fixation on the U.S. stock market. So when we hear bear market, bull market, when we even hear market, what do we think of? We think of the stock market because headlines are not made. What happened in the bond market today? What happened in the commodity markets today? What happened in the real estate or REIT markets today? We hear every day what's happening in the stock market. We also know, if you're a listener of this podcast to a degree, but probably more following my weekly financial column, that it's really important to have a diversified portfolio, not put all of our eggs in one basket. So very few of us that are investing for the long term have a majority of our investments in the U.S. stock market. And yet that's what we hear about all the time. So we've been hearing a lot about a bear market. And a bear market is when the stock market, or any market for that matter, falls 20% from the high. So the U.S. stock market is definitely fallen from its highs. In most portfolios this year, they're down. If you have a diversified portfolio, probably your portfolio is down about half of what the stock market is. So it's typically never as bad as what the headlines make it. Now, if you want to really take a look at a market that's in a bear market, take a look at the bond market. It's in its first bear market since the 1970s. That's 50 years ago. And by some measures, we're having the worst returns on bonds since 1842. So interest rates have actually been in a bull market, like I said, for 50 years, which means interest rates have gone down. And that's hard to get our heads around, but when interest rates go down, the value of bonds goes up. And so interest rates have been going lower and lower and lower for 50 years. That trend is now reversed, and we're seeing interest rates rise, which is bad for your investments in bonds. So for most of us, this is a new experience. I happened to be around in the late 1970s, 1980s. I got my start in real estate during that period of time. And the average mortgage rate was 9%. For a period of time, houses appreciated at around 10. I remember looking at 25-year historical appreciations of real estate, and they were 6 or 7%. And in fact, I remember when a VA loan at 7% was a steal. Like, holy cow, you're kidding me. This, I can assume a 7% mortgage? And today we're just dumbstruck at 4.5% and 5%, and possibly going higher. So when we have markets going against us like this, when we see our investments going down, when we see our investment portfolios going down, we can have a lot of anxiety. Now, it's not a given that you will have anxiety when you see your investments trending downwards, when you see your portfolio going down. Now, some of you are like, what? How is that possible? How would it be possible not to have anxiety about your portfolio going down? By the end of this podcast, I think you'll understand why that is possible. But nevertheless, there is a ton of anxiety right now amongst a lot of investors. What is anxiety? All right. Anxiety is a feeling. Starts as a sensation. For me, it starts in my stomach, and my stomach just knots up. And typically those feelings with anxiety are worry, nervousness, being uncomfortable, an uneasiness. Why? That typically grasps us when we anticipate a negative outcome to an imminent event that we are sure is going to happen. Doesn't mean that it is going to happen. We're sure it's going to happen. Or uncertainty. Uncertainty when we don't know how this is going to end up. All right. So a lot of folks today are feeling a lot of uncertainty with the stock market, with their portfolio, because in many cases, they don't know where this is going to end up. So I want to maybe give you a little information as we go through this that might help you with your anxiety. The first thing I want to say is that whatever you're feeling, you're feeling. Feelings are a fact. Feelings are not good. They're not bad. They're like money. Money isn't good or bad. Money just is. Money is an inanimate object. Feelings are not good or bad. You say, but wait a minute, Rick. Isn't anger a bad feeling? Anxiety is a bad feeling? No, I would suggest not. Well, isn't happiness a good feeling? Peace a good feeling? I would say no. I think we have difficult feelings. We have light or easier feelings, but they're inherently not good or bad. They don't inherently cause good behavior or bad behavior. It's what we do with the feeling that can cause a positive or a negative outcome. You can be feeling happy and joyful and make some really bad financial decisions or bad decisions, period. And you can be feeling sad, scared, anxious, and make some really good decisions. So feelings are information, right? And one of my mentors once said that a feeling is the bell of awakening, right? It lets us know. So it gives us information. Something's going on. So I know many of you are saying, well, I shouldn't be feeling anxiety with the market going down. Not to feel that. So let's not should or ought ourselves. And many of you are saying, well, I shouldn't be feeling anxiety because typically markets recover, which is totally true. Totally true. But the fact you're feeling anxiety, you are, and it warrants a deeper dive. So there is a reason why that anxiety is there. Now, sometimes it's more information is needed. For example, if you don't know that markets typically recover and eventually stocks will go to zero, well, then it's a pretty legitimate worry, right? Of course you're feeling anxiety. But in the case I just gave where you're going, yeah, I know markets recover, but I'm still feeling anxiety. There's other reasons now that are anchored or that are anchoring that anxiety. And it's probably coming from some type of unresolved trauma from past experiences that have little to do with the current falling market. So pay attention to that. If it seems illogical or unreasonable that you're having anxiety with the falling market, then that's a sign to look someplace else rather than the knowledge. So with that said, I want to delve into some of the knowledge that could be helpful if you're feeling anxiety around the current stock market. The first thing is to understand that inherently stock markets, any market, is uncertain. There's never a time that we are not uncertain about future prices and market trends. You know, we laugh about the crystal ball. A lot of people make a lot of money selling newsletters where they are telling investors exactly what's going to happen, exactly the stocks that are going up, that are going down, and what you need to be doing. I obviously do not subscribe to any attempt at certainty or understanding if markets are going up or down. Every investment is uncertain. Every one of them. You might say, well, Rick, wait a minute. Cash in the bank isn't uncertain, is it? No, probably the bank isn't going to close and you're probably not going to lose your money, although that's a chance. But what is uncertain is something called inflation. You can have money in the bank and the dollars are not going to go down. But what can go down that you don't see, that's really hard for our brains to internalize, is the purchasing power can fall. So if you had $10,000 in your checking account last year, you need $10,800 because inflation's around 8%. You need $10,800 in your account today to buy what $10,000 bought last year. So that's an uncertainty, isn't it? It's an uncertainty what my money's going to buy in a year, 5 years, 10 years, 30 years. So, and I would submit to you that when purchasing power is stolen, especially from money, from cash, money in the bank, that money's lost forever. Very, very little chance. Only if we had deflation would that money ever be regained. The flip side is when you have money in stocks, bonds, real estate, commodities. Even though that money, you can actually see it go down, as in many cases we're seeing now, it has a chance to go back up and to recover and to even keep pace with inflation and protect its purchasing power. So uncertainty is in the markets. Markets go up, markets go down. Volatility is inherent. And the only way that a person really has a chance of keeping their purchasing power intact or increasing it is embracing uncertainty and investing in these very uncertain markets. All right. Well, does that make sense? Because they're uncertain, we might lose our money. Well, you can lose your money. The chances are, if you do this soundly, intelligently, with a strategy, with an eye on history, the chances that you will lose money in a long-term portfolio, we're talking saving for retirement, are extremely remote. One of the things that these parts of ourselves get locked into, causing anxiety, is that they don't believe that they will ever recover from the former highs, or even that our investments are going to become worthless and that the losses will be permanent. All right? Well, if that's true, then there's a lot to worry about, right? If you own one stock in your portfolio and that stock was Kmart, as I once famously bought, well, it's not very famous, but it was 50 cents a share. I thought, oh, this is a good deal. Well, I went bankrupt. I lost everything, right? Everything in that stock. That's what you have everything invested in. Well, going to zero is a potential concern. And that would be a permanent loss. But we know we don't invest that way. We invest in indexes. We invest in mutual funds and ETFs that own hundreds and thousands of stocks. The stock portion of my portfolio is in 12 or 13,000 different stocks around the world. And it's very easy to own that, very simple and very inexpensive. So I don't have to worry. I have no anxiety about things going to zero. Quite frankly, the chances of a basket of stocks like that, the chances of my 12 or 13,000 stocks going to zero or going down and staying down is somewhat the same as an asteroid hitting the Earth tomorrow. It's possible, but it's highly unlikely. The likely scenario with any portfolio that's diversified that goes down is that in the next year or two, the markets are going to rebound and that they'll be testing their new highs. That's what's happened time and time and time again. We've had 28 bear markets since 1929. All 28 have recovered. All 28 have hit new highs. So there's not one time that we've had a bear market that it didn't come back. Now, some came back like in March of 2020, came back in a matter of weeks. Others, like I think in the 30s, took 5 to 10 years to come back. But the point is, they came back, which can lead us to one of the fears around this, that it will never come back, is anxiety over the ability to pay for our future lifestyle. In other words, if the markets go down, will I be able to afford to retire? If they go down and stay down, if they go down to zero? Well, of course that's a concern if that happened, but it's never happened. So if you're earning an income right now and you can cover your lifestyle expenses, this isn't an issue. High probability they're going to come back. If you're retired and you've done what I've written about, and you have 1 to 5 years of in cash in the market, or I mean in a money market, and you're getting your Social Security and your pension, you're going to easily be able to weather a 1 or 2 year market crash. So these are all anxiety busters, right? That we can implement that can really help, like implementing the reserves, that can really help reduce anxiety. Or just the knowledge of this can help reduce anxiety. Another thing about unpredictability. The fact that stocks are down significantly was completely predictable, totally predictable. The fact that stocks will enter a new bull market, completely predictable. Just like almost no uncertainty in that. I have been saying since 2008, when that was the last real major crash we had, that we will have another stock market crash. I mean, 99.9%, right? The thing is, we don't know when, right? We don't know when, but we know that that's going to happen. Another thing, just to understand when we talk about a bear market being down 20%, well, that's usually not the end of a bear market. Most bear markets are down, I think 36 to 42%, somewhere in there is the average bear market fall from the high. They can go up to as high as 50%. So usually when you hit that 20% mark, the party has just begun. Oh, okay, well then let's sell and get out and let it fall and we'll buy at the bottom. Well, yeah, in theory, that's a great idea. But rarely can anybody execute on that. Typically, there's only really one way where a person is guaranteed to lose money in a stock market downturn or when your portfolio is heading down. And that is if you sell out. And what happens, I think we've talked about this before, but what happens in this case is we have this vulnerable part of us that has all of this anxiety. And this anxiety could come from all sorts of trauma. It's typically unresolved anxiety. And we have parts of us that manage that anxiety, that have money scripts around that. Some of those money scripts could even prevent us from getting in the market, like the market's gambling. You could lose all your money in the market, so let's not get in so we don't feel the anxiety. Sometimes those managers will let us get in, and if the market's going up, that little anxious, vulnerable part of ourselves is fine. We don't have an anxiety because we're seeing it go up. We feel good about that. We're happy about that. There's no uncertainty in that because markets go up. Well, we know that that's not true, but just think if you were an investor, you started investing 10 years ago, that was all you ever saw were markets going up. It wasn't in your experience that they could go down and go down significantly. So when the anxiety starts really bubbling over, there's another part of ourselves at an IFS we call a firefighter. And this is a protective part that says, okay, things have gotten bad. The manager hasn't succeeded in keeping this anxiety down. Now it's busting out. Markets are down 20, 30, 40%. And panic is erupting in the system. And this firefighting part of us absolutely wants to soothe the anxiety and take scorched earth policy or actions. And this could be in the case where a person maybe drinks alcohol, helps soothe that anxiety. Could be work. I mean, anything that's addictive can be used as a soother by the system. In this case, it's getting out of the market. Let's just sell out, sell it all. And what happens when we do that? Well, there's relief. Yeah, that soothes the anxiety. The problem is the anxiety starts building again when markets start going up and we're not in the market. And it's this, maybe it's not time. And then maybe we see the market go down again. Okay, good. I'm glad I didn't get in. Then it goes up. By the time the markets are at new highs, we are super anxious, fear of missing out, FOMO, fear of missing out, and anxiety can get us back into the market at precisely the time that within a few months it starts going down again. So that's the losing roller coaster. How anxiety that is unresolved can just eat our lunch with these parts that are just trying to deal and manage with this anxiety. Because when we get back in the market at high, we feel relief. Oh, good, at least we're back in. So this is the roller coaster that's going on. And what we really want to address. So markets are uncertain. We need to work with that part of us that is anxious and help it to really resolve that anxiety so that our managers don't have to be so rigid, don't have to be trying to shut down that anxiety. Because ask yourself this, if markets went up and if markets went down and you didn't feel any anxiety, how would that be? There'd be nothing to manage there, right? And that's possible. So there are some of us that have every reason to feel anxiety when markets go down, and those are people who need the money that's invested right now. They've got the money in the stocks, it's going down, and they need that money right now for whatever expense, college, buying a house, whatever it is. They will lock in their losses. The only way that you lose money in a down market is if you sell, or you have to sell. For the rest of us, hopefully this is helpful, and hope that it brings some solace to your anxious parts. Thanks for joining me, Rick Kahler, for another episode of Financial Therapy. It's not just about the money. This is where I combine the nuts and bolts of financial advice with the emotions that drive making them. Remember, every financial behavior, whether it appears illogical to you or others, makes perfect sense when we understand the underlying beliefs, feelings, and thoughts. Sign up for my weekly blog at financialawakenings.com. I hope you'll join me again for our next episode.